Today's session, ladies and gentlemen, we will talk a little bit about the investor sentiment for 2016. Now, why am I talking about 2016 in general and as an annual basis? Well, it is extremely important to understand, of course, for those that have no idea, to understand that investors are mostly focusing on price change on an annual basis. So therefore, at the end of the session, I will give you some projections or forecasts, for US dollar majors, crosses, as well as some exotics. This is based on my artificial neural prediction model that I use to find out what would be the levels of currency pairs in terms of the next few years. So we will talk about the final quarter of this year. Of course, we're in the last month of this quarter, the whole 2016 and the whole 2017. First of all, because if you're an investor and you're attending this webinar to better inform yourself of others' opinion, you need to know what are our projections and what are in general investors' opinions and of course the sentiment for the next year. Now, the session today will be most of it as I've found out about these particular sentiments, let's put it this way, by speaking with investors all around the world to find out what exactly they're looking for to invest in, what they think about commodities and currencies, and most of all, of course, through research from past data to, of course, link it to the investor's opinion, their sentiment, so we can actually find out what in general investors are mainly focusing in for 2016. So we can, of course, look forward for better trading opportunities. Now, if we are day-to-day traders, this is also a helpful thematic based on the fact that investors' opinion matters on the persistence of the market's direction. So if an investor, for example, thinks that a currency pair is going to head down and it's going to finish below, let's say, as an example, the euro-dollar, if the euro-dollar is heading for parity, now what matters is the outlook of this sentiment towards which quarter, or mainly whether until the end of the year is when this particular event is expected to occur. But before we actually head into the main topic today, the first thing I need to just focus on is, in general, what is actually investors' sentiment. What does it actually mean? I do understand that most of you guys here are well aware of most of the terms and the acronyms into the trading environment. However, for those that are here for the first time, I need to turn this attention. Investor sentiment is the view of the market by investors. This is the combined view of all investors at any one time. Now, since this is not a static, but rather always changing, investor sentiment is usually seen in three general categories. So, the first one is extremely optimistic or bullish. The second one, extremely pessimistic or bearish sentiment. And based on their equal in number optimism and pessimism, we're qualifying it as, of course, the neutral sentiment. So, the view of investors participants can be, of course, based on either a fundamental or a technical reason. So investors' sentiment in general is seen as moving domain indices, which of course will push individual stocks in its wake. Which means you can also see exactly where the economy is heading. Therefore, the local currency will also appreciate or depreciate depending on the direction of the economy itself. So, by the investor sentiment, we can judge for indices, stocks, currencies, commodities, basically for everything. Why? Because the investors, or in general, individual persons with thick wallets, let me put it this way, they have the ability to participate on a larger scale in the market environment, therefore giving direction by forcing the market with large volumes in a certain direction and influencing by opinion on a governmental area and level. So when we speak about investors, we're probably focusing on the most important topic among the traders' environment, and as an information, this will help you a lot to further suggest at what direction a particular currency is heading, and of course to know how to position yourself as well. This is why today's topic is so important. For example, an economy might not be a great stock in value, but if the investor sentiment for the overall index is extremely bullish, this optimism will push up the price of most, if not all, stocks. So you see, this is a very good example how the investor sentiment can push the market in a direction. Many view extreme market sentiment readings as, let's say, contrary indicator, when of course most people are bullish, or others said optimistic. The market is close to a short-term top and vice versa. Let's focus now on an individual instruments in general, like trading instruments. The first one, we will focus on gold. Now, why am I focusing on gold? Well, the first thing, because it's dominating the commodity market. Second of all, because it has intrinsic value. Third of all, because it's denominated in US dollars in general. And number 5, you can actually guess what the condition of the economy is by looking at the long-term trend in gold prices. Obviously, gold is seen as a safe haven, a hedge against inflation, and most of all major economies hold gold reserves in terms of a downturn in an economic overview, so they can exchange the physical bullion for cash in order to pay wages, taxes, governmental expenses, so on and so forth. And this is the place where I have to mention that for the past 1 year, Russia is #1 purchaser for gold in reserves. Now, gold dips on a weak sentiment, which is actually expected to persist 2016. Gold futures declined as investors' sentiment continued to erode and the dollar rebounded on strong U.S. employment data. Now, one thing I have to add here. Right now, the dollar and the index are not at the highest levels. You can judge that by the exchange rate between the US dollar and the Japanese yen. Right now the dollar is actually much cheaper. Also, the exchange rate between the GBP and the US dollar and the euro versus the dollar. Of course, the influencing factors among those currency pairs are various. However, what we need to know is that those factors are driving a currency up and of course devaluating the other one in exchange. Obviously, the case for gold is not the expensive dollar right now or the cheaper dollar, why the prices are sliding. It's mostly because of the looming interest rate hike, which of course is pretty much the most important event this year. That of course to look a little bit back at the beginning of the year where we see gold for February delivery. Now when I'm talking about delivery, I'm talking about the contracts of gold, not the spot price. But of course the exchange rate is pretty much the same with just a few dollars difference. But when we're looking at investors' sentiment, we need to look at gold futures. Now, why we're looking at gold futures and the spot price as well? Because of the difference of the price. Now, usually, the contract is a bit more expensive than the spot price. But right now, it's vice versa. The futures is much more cheaper than the spot price. That means we can expect a bottoming level of gold and a possible reversal. Now, when exactly this will occur for the prices to bottom in order to pick up a new trend, we are yet to determine. It is likely not to happen at least until 2017. Until then, during the whole period of rate hikes, we will be looking at particularly lower prices, lower to stable neutral prices, let's say. Of course, exchange rates close to $1,000 an ounce, probably $984 an ounce, where exactly stands the so-called long-term trend, 100% retracement. Actually, I can show you this on the chart here as well as we are on the gold chart. Let's have a look at the monthly chart. Now, this is the 975.65. Now, if we actually have a look at the moving average, that's the 200 exponential, the 84-85 levels on a monthly basis, we can see that there is a lot of resistance here where it's expected to probably pause in reverse for some time. So this would be a very good level to go long on gold. Also a good level would be somewhere here to 855 if of course the prices have reached that level, which is not excluded. But until the 985 level, we're looking at a lot of resistance here on this monthly basis sideways chart here. And of course, pretty much the levels of the moving average will be close to that particular level when the price, or if the price reaches it. So let's continue on the annual base of rate change. Bureau was last down $5.6 or about 0.5% to about 1058.20 an ounce. Now, from then on, the trading has been ranging between 10.58 to 10.69, 6.70 in today. Now, in a preview of Friday's official U.S. Employment report, that was last week, ADP non-farm employment change for November, however, showed that the American economy added 217,000 jobs, a sizable gap between the 191,000 forecasted. Also on Friday, we saw 200,000, which was a very good number. Additionally, preliminary non-farm productivity and labor cost quarter over quarter rose 2.2% over a 1.8% respectively at the last meeting, and of course beating expectations. The employment reports are actually the last key data before the Federal Open Market Committee to determine whether to raise rates before the year end. So, the robust employment data saw the investors bid up the dollar to 1.0586 against the euro at that time. Now, when the central bank made the European Central Bank made its announcement and disappointed the investors, which were bearish at that time, drove the euro versus the dollar to another close to 500, close to about 500 pips higher. Now that was for one day, 500 pips higher. That, if we have to look into a gold change, that would be $50 of gold change price, or 50 points. But we cannot talk in points with currency pairs because points are on the left side, pips are on the right side. So we expect investors to continue to liquidate positions in the months ahead because of a higher US dollar. Nonetheless, it is retracing right now, but that doesn't mean that it's not at a high level, and higher US rates, obviously. It is also likely that new lows in prices will be reached before the end of first quarter of 2016. So our expectation, should I say my expectation, is for gold prices to break below 1,000 an ounce in the upcoming months. Now, if, I'm saying if, the Federal Reserve raises rates next year, we can expect on every US data to have declines in gold price. It is obvious because the better data we're getting, the much more the likelihood of increasing rates in next meetings with the Federal Committee are much higher. Why is that? Well, first of all, because as you spoke the last time, raising interest rates by the government of the United States is the most powerful tool they possess in order to subdue or cap inflation, in order to prevent hyperinflation, obviously. So the market participants are also likely to remain cautious ahead of meetings next week, which of course could affect the dollar and the gold price. So as for other precious metals, let's have a look at the silver for the next year. We're expecting to see some lower prices as well as other precious metals like platinum, rhodium, and so on and so forth. But since they're less traded we're not going to focus that much on it, unless, of course, there is someone among you that is also focusing on other precious metals. We can handle that on a one-on-one session. Just make the request by the usual channels, and I will be right with you. So right now, actually, I want to focus on something else. As we already went through the gold in general and how you can actually, by using the gold price, how to determine what's the direction of the economy. So if it's going down, that means the economy is quite well. The Federal Reserve will start raising rates. However, when this occurs, we will also see long positions on gold. People will start looking for the end of this particular rate hike so they can freely start buying and investing in gold. But right now, we're seeing the prices subdued for the time being. ASX S&P 200 Australians Index. I believe some of you might be interested in Australia, not only because the local currency is a commodity currency, because Australia is one of the biggest gold exporters. This is one of the reasons why I'm actually heading into this after we spoke about gold a little bit. So the Australian shares rode a way of improving global sentiment, with, of course, all sectors finishing in positive territory after, of course, we saw the investors ready for the earnings season. And most of all, we're looking at some good job data. Unemployment rate is falling, as well as this is very good for local currency. 100 pips, by the way, jump in Aussie USD right after the announcement. The Dow Jones Industrial Average and the S&P 500 chalked up gains for more than 1%, while, of course, the Nasdaq Composite lagged quite a little bit. Let's look at China, also the shares over there. It is very important to note, for those that are focusing on Australia as well, is because China is one of the biggest, mostly the biggest trading partner of Australia. So whatever happens there quite largely can influence the indices in Australia, the local currency afterwards as well. The Shanghai Composite Index lifted 3.4% after, of course, the People's Bank of China earlier announced it would inject liquidity into China's share market in response to the 8.5%, the biggest in 8 years slump in the yuan. You do remember about this particular event, I'm pretty sure, because right then gold flew sky high. It reached 1,200 an ounce very shortly. So the positive leads that was sent to the Australian market higher for the benchmark ASX 200 index to close 0.7% higher at a certain level, and of course the broader all ordinary 0.7% higher as well. Now, the Shanghai Composite Index, however, is actually up 13% for the year compared to the Dow Jones, which, of course, despite the rally, is down 1% this year and trading below the 200 moving average for, of course, fourth consecutive week. Now, these, of course, are leads from the data that I've been gathering throughout the year, because this webinar was scheduled long ago in my calendar. You are aware that we need to be prepared for everything. So, to be honest with you, when the first time the Federal Reserve probably gave a bit more hawkish view over the economy, that was in the beginning of the summer. All right, I was gathering my things to head for a vacation for a couple of weeks. I was, repainting my boat, as well as I was gathering some things around with my family. So we were getting ready to sail away. Also, right then I took a glance of the numbers, you know, that have been gathering so far, and I totally didn't saw any rate hike until September, to be honest with you. I was even surprised that they held off on September, but probably that was for some other reason, speculative reason probably. They have something to do, you know, probably they needed the market lower at some point. But you see, it is respectively, at that announcement on September, we saw a bit of a hawkish statement for the December rate hike. So since then, gold dropped with $100. And of course, those of you that are here, I'm pretty sure there are most of you that are here right now. We spoke about the GDMfx pattern on gold daily chart. Let me just show it to you when this event happened. Okay, this is the daily chart. So when we spoke about this GDMfx pattern, which was measured from here, I believe you can see the moving averages. Sorry, not the moving averages, the trend lines that I'm getting to you. So here to here, and then when I mentioned the 86 price of gold, you can see the closing was at 1185, 179, close to 186. Exactly per prediction, the gold price reached a new top from where we saw $120 slide in gold price. Of course, our projection was for $100 drop, whereas exactly here at 1085 from 1185.86. You can see where gold prices sidelined for some time before they kept declining. But this was our projection. We were short on gold once we saw the 1186 price, because the GDMfx pattern was, how to say, perfect in general, and it confirmed by the book. And this was predicted long ago. There are those here that are actually sending messages right now that they remember this webinar. We've been talking about mostly about gold and the fundamental factors that are influencing gold. So I'm pretty sure that even if you browse through our webinar series, you will find this webinar where the statement was made and verify what I'm trying to say right now. Now, also it is extremely important to note among gold miners, the renewed bearish sentiment over the price of bullion pushed Newcrest. This is a mining company down in Australia, 1.6% lower to 11.36 a share, although Regis Miner 1.5% to 1.32 a share. So, talking about the US dollar, as we already mentioned, we are expecting to peak versus major currencies in 2016. Remain positive on the US dollar across the board, and we expect new highs in 2016. 0.95 in euro dollar price, 135 USD JPY, 1.25 GBP USD, and 1.21 USD Swiss franc. Monetary policy divergence and positive investors climate are the main ingredients that are likely to push the US dollar higher. So, for those that are extremely focusing on, let's say, annual-based trading or more of a quarter-to-quarter trading, those numbers that I'm mentioning right now are extremely important. Later on, I'm going to give you those projections that I have for major currencies, exotics, and crosses on the dollar, as well as I cannot really cover everything. I've been calculating these for the past 2 months. So it took me some time to calculate, let me see here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12 currency pairs for about 2 months. So this is 6 currency pairs per month. Imagine the formulas and the calculations. Of course, the artificial neural network projections system that I'm using is working quite well. The formulas that I've been developing, of course, not me personally, but I have to make them work. So anyways, I'm pretty sure that if there are any people that are interested in such a thing, I would be, of course, happy to share everything that I know. Now, let me mention those numbers one more time. Of course, these are general numbers, but later I'll break it down to quarters. So 0.95 in Euro USD, 135 USD JPY, 125 in GBP USD, 121 US Swiss franc. Monetary policy divergence, as we mentioned, and positive investors' climate are the main ingredients that are likely to push the US dollar higher. The Federal Reserve is expected to continue hiking rates in 2016 and 2017, reflecting the strength in US economy, bringing the Fed funds rate to 1.25% at the end of 2016 and 2.25% at the end of 2017. Currency financial markets are also expecting less Fed rate hike next year. The Fed's fund futures are only pricing in 0.82% and 1.35% in the end of 2017 and 2017, respectively. As we see, it is likely that financial markets will catch up to this overview of a rate hike, consecutive rate hikes for 2016 and 2017 in the course of 2016. At the same time, the European Central Bank and the Bank of Japan are set to step up more stimulus to boost your economies. The ECB is likely to set up quantitative easing and cut its deposit rate deeper into negative territory, not just these 0.3% we saw quite recently. The ECB, of course, is likely to increase the quantitative easing program due to a more expensive euro, as you can see. So we're expecting the US dollar strength to mainly materialize in 2016. It is likely, of course, that a slow pace of federal rate hike will go track on track with the environment of positive investors' sentiment towards the economy of the United States. This way, the US dollar will fully profit from monetary policy divergence in 2016. If, of course, general investor sentiment is to deteriorate, which is not our main scenario. However, we also keep that in mind, because if there is a trader that do not think about the consequences of the reversing type of market, if you have made a wrong projection, of course, you need to be ready to stop your trading at some point to prevent further losses. If in general the sentiment is to deteriorate, which is not the main scenario at this stage of the firm, that upside in the US dollar will likely be capped, and we will see reversals in the DXY, which is of course the dollar index, a main chart to all investors and traders that are focusing on major currency pairs and commodities. Is a powerful tool to look at it. And of course, is also likely to decline in 2017. However, the particular 2017 year will be the year that multi-year US dollar will ascend since 2011, and of course it will come to end. At the start of 2017, most US dollar supportive factors will be reflected in currency markets in our view. Of course, in addition to that, major central banks will end their quantitative easing programs, as we have seen in the case of the United States. The moment that tapering assets purchases come to end, the currency will likely to recover, and we're talking about the euro. So that will of course push the US dollar down, the euro up, and this will the same go for either major currencies. Basically, this would mean that the financial markets will start stabilizing in a global overview in 2017. Now, the northern central banks like Sweden, Norway, Switzerland will also end their monetary policy stimulus in line with the prospect of tapering by the ECB. As a result, of course, growth differences will start to have a more dominant impact. Also, we should note here that the Norwegian kroner should recover strongly, because we are expecting the oil prices to move higher towards $75 a barrel at the end of 2017. And in the case of the dollar-yen, the prospect that the Fed rate hike is being fully reflected in the dollar will likely stage a recovery of the yen versus the dollar, according to, of course, the purchasing power parity and the value of the USD JPY, which is at, let's check out the graph here at this stage. We'll of course go to monthly chart. Take the Japanese yen, let me see, here it is. Which will, of course, we're expecting to see numbers below 100 down to below 90 versus the dollar. Now, speaking of the British exit fears, something that is weighing on growth on the sterling, and will keep doing that in 2016, as the British pound is one of the widely traded currencies, not only versus the dollar, but versus the euro, the Japanese yen, the Australian and the New Zealand dollar, so on and so forth, even the Singaporean dollar among foreign traders. Sterling will be the weakest performing major currency in 2016, in our opinion, based on the financial and fiscal consolidation past sterling strength and the fear of exit from the euro area will also weigh on the UK growth and result in later start of the Bank of England liftoff that currently is anticipated in the financial markets, which we do not expect to happen until third quarter 2016. Therefore, we have added sterling short positions versus the euro dollar in our trading platforms to, of course, to the higher priority trading currencies, as well as the looming rate hike, higher rates in the Dixie, and of course stronger dollar in general will drive the British pound lower, as we mentioned in 2016, a rate of 1.25 versus the dollar. We expect that the UK government will hold a referendum on the British exit policy in the third quarter of 2016, before the referendum in 2017 that was promised by the Prime Minister of UK. it is unlikely that the Bank of England will hike before this particular referendum. So even if it happens, it is highly likely to happen after the waters cool down in the particular referendum that we expect to happen in the third quarter of 2016, to hike rates somewhere around September to December 2016 or early March 2017, depending on economic conditions, but not early before fourth quarter 2016. Moreover, this will be followed by a strong recovery if British exit is avoided. Our main scenario in this situation, however, is that it will be avoided. As a result, we expect sterling to recover strongly following the particular events which are expected to happen in 2016, third quarter. The outcome of this will happen because the focus will turn to the start of Bank of England's rate hike and the cycle that will follow. Compared to market expectations, of course, we are seeing less rate hikes for about 2016, but more tightening in 2017 for the British economy. Therefore, the rally of the sterling is expected to happen in early 2017, first to second quarter. More weakness in the dollar block, however, currencies in 2016, but a recovery in 2017. Also, we remain bearish on the Australian dollar, the New Zealand dollar, and the Canadian dollar, mainly because of the monetary policy divergence and the continuing drag on the economy from the correction in commodity markets. In 2017, the expectations are for Reserve Bank of Australia, Reserve Bank of New Zealand, and the Bank of Canada to start tightening their monetary policy more than anticipated by most market participants. This kind of recovery in commodity prices and weakening of the US dollar will likely strongly support these particular currencies in 2017. Now, let's take a look at more a geopolitical standpoint before we turn attention to Central and East European foreign exchange markets and the current developments in the Turkey region, and of course the lira, if anybody's actually trading this. But of course this particular type of currency, as it's seen for extremely how to say, sensitive to geopolitical events, especially in the region of Turkey, Syria, so on and so forth. The unfortunate events, however, that we saw recently, not only the downing of a Russian jet in the Turkish border, so we saw the lira just falling into oblivion. Commodity emerging markets to turn the corner is expected in 2016. Of course, most currencies of emerging markets, commodity exporting countries, also have suffered considerably over the past few years. They have declined by about 20% to 55% versus the US dollar. And we're looking at the emerging market currencies that they've been hit all over again to all-time lows. While of course the sharp weakness was mainly the result of lower commodity export revenues, also by a weak domestic economies, soft investor sentiment, and geopolitical challenges. This currency weakness will likely result in positive developments in the trade balance of these particular currencies. These currency weaknesses will likely result in positive developments in the trade balance of most of the currencies in the Asian region. Moreover, the slowdown in China will be gradual, resulting in growth exposure in higher yielding currencies. The Singaporean dollar, the Japanese yen, so on and so forth. Also the Malaysian ringgit. The latter should lead to a possible searching for new global growth exposures by most investors by their easing cycle and the next step to tightening. So, what is the main important thing we actually see here? Weakening currencies due to a quantitative easing program, bond buying program, so on and so forth, starting to recover as the economies recover along with that, which means when this starts happening, we can start looking to a tighter monetary policy, as we saw this in the US. A beautiful example for what is up to come in the Euro region and the Asian countries. However, there are also clear negative for some of these countries throughout 2016. Most of them will remain vulnerable as interest rate hikes in the US are up to rise. Other headwinds could be the domestic political situations, the economy, and possible downgrades from certain institutions. I don't really like to name those. If we take all these positive and negative factors into account, we would see recovery in Latin American countries, the Russian ruble, South African rand, mostly because of the stabilization of commodity prices and some improvement on the domestic front. We expect this recovery to continue throughout 2017. That leads us to take a very brief glance into Eastern European foreign currencies and Turkish lira in general versus the euro. Economic fundamentals for the particular region of the Central and Eastern Europe will continue to improve in 2016. The economies such as Poland, Hungary, Czech Republic, so on and so forth, will profit considerably from stronger Eurozone growth. Below the surface, however, inflationary pressure will slowly start to build, making the case for monetary policy tightening in 2017 and the abandoning of the euro versus the Czech Kronor, which is about to happen in the end of 2016, pretty much because Czech Republic is moving directly to euro. And there will be no more trading the euro versus the Czech Kronor. In addition, the currencies and the current situation account deficit for Turkey shows tentative signs of improving by the central bank, which is likely to make monetary policy more transparent, and the political uncertainty may decrease. However, this very much is, I'd say, it's more of it depending pretty much on Western Europe and Central Europe, mostly on UK, France, Germany, also Sweden as well, and as well as Denmark. Now, all of those countries, Belgium as well, let's not forget, all of those countries are mostly focusing on getting rid of the I'm sorry, but I have to say it, by the poisoning individuals at this stage lurking into the European countries that are trying to somehow destabilize the region by attacking peaceful countries. So, in short, the expectations of these currencies to outperform the euro in 2016-2017. Let's take a look at the recovery in the Asian sector. Also, the currencies over there versus the US dollar will actually arrive in 2017, when we expect the whole tightening program from the United States to end, diverging policies to stabilize, and of course for much more weaker US dollar. Therefore, over the coming year, the expectations of the Chinese authorities to maintain their current policy of engineering a gradual depreciation of the yuan to support exports and inflate the economy is to persist. We also expect that the People's Bank of China to reduce volatility in the yuan and narrow large disparities between the onshore and offshore yuan. As of course economic growth in China stabilizes, capital outflows are expected to decline, and this will reduce the need for the People's Bank of China to intervene in the currency market. The IMF, on the other hand, is expected to agree with the inclusion of the yuan in the SDR basket, which happened so far, and that was the biggest mistake because they've done it too early. And these effects will bear throughout 2016. In our view, the effect on additional demand from central banks for the yuan as a reserve currency will be kind of limited, as the SDR represents less than 3% of total global foreign exchange reserves. The role of the SDR, however, as a reserve currency will rise only gradual. We expect the yuan to decline versus the US dollar to 6.55 by end of 2016, and followed by a stabilization in 2017. We remain, of course, bearish on most Asian countries in the 2016, as weaker Chinese yuan, euro, and Japanese yen will remain headwinds for Asian exports, and monetary policy easing in Asia will, of course, also weigh on their currencies. And of course, the Asia ex-China GDP will improve moderately in 2017. Inflation then will rise across the board, and hence central banks are expected to tilt towards a tightening bias. Growth, of course, will and carry trades will come into picture in 2017. Valuation of the Asian FX, of course, should also be more attractive by 2017. As a result, China foreign currencies will recover in 2017. The Monetary Authority of Singapore will likely step in the scope of Singaporean dollar near appreciation in 2017. This should support the Singaporean dollar heavily. In the case, of course, of the Thailand political stability is also expected to happen in 2017. Well, ladies and gentlemen, that's all about the the 1 hour talk that I just went through. I will be very happy if that was in some case helpful to you, as well as it's very helpful to me, though, to keep profiting from the markets. Now, in your convenience, I've made a few projections. However, they're based on the last prices that I took into account in November, which were for the euro dollar 1.0616 when I was calculating these. However, it is of course valued. The first quarter of 2016, we expect 1-to-1 parity of the dollar. Second quarter 16, 0.95. Third quarter 0.95. Fourth quarter 0.95. First quarter 2017, again up to parity. Parity in the second quarter, and a gradual rise in the third quarter of 2017, 1.05 again to 1.1 in the fourth quarter of 2017. Japanese yen, USD JPY, 122.55 when I took the price on November. 125, of course, is expected to be seen until the end of the year. First quarter of year of 16, 127. Second quarter, 130. Third quarter, 133. Fourth quarter, 135. First quarter, 2017, 130 yen per dollar. Second quarter also unchanged. Third quarter and fourth quarter gradually higher with 1 yen to 131 and 132 respectively. The cable, GBP USD, 1.51 was the price I took in November. 1.50 is expected to be seen around the end of this year. First quarter of 2016, 1.41. Second quarter, 1.28. Third quarter, 1.25. 1.27 at the end of 2016, the fourth quarter, and gradually lifting head up when we see the monetary tightening, the local policy over there to 1.37, 135 on the first quarter, 137 on the second quarter 2017, third quarter 146 and 157, fourth quarter 2017. Now let's see some Euro GBP prices here. The price I took was 0.7030. We see 0.70 at the end of this year, 0.71 first quarter 2016, 0.74 second quarter 2016, 0.76 third quarter, 0.75 at the end of next year, and of course gradual decline of the euro versus the pound because of the monetary tightening policy, which is expected to occur at that time at 0.74 first quarter 2017 and 0.73, 72, and 70 respectively, third and fourth quarter. USD Swiss franc. Base price 1.0239. First quarter next year 1.1. 1.18 second quarter, 120, third 121, fourth. First quarter 2017, we're expecting to see 115 unchanged throughout second quarter and slightly starting to decline in 2017, where of course the dollar is expected to get higher in the Dixie. I'm sorry, I'm looking the gold price on my other window here, on my other monitor. Let me show it to you. It's gradually starting to decline. Okay, it's the monthly chart here, so we have to change it. Let's take a look at the hourly chart. We can see that it's on a heavy resistance of 1062. When this one breaks down, we can expect some sliding throughout the day. It really depends on the retail sales. We'd expect it are actually imminent in about 27 minutes from now. So I'm not going to keep you too long in front of your computers, especially in front of the webinar. So just a few minutes and I'll be done. Bear with me. Let's have a look at the Australian dollar versus the US dollar. The price I took at that time when I make the calculations, 0.7226. First quarter next year, 0.62, 0.66, 64, 62, respectively. Second, third, and fourth quarter 2016. First quarter 2017, 0.64, 68, 70, 72. Respectively, rising throughout 2017. New Zealand dollar, base price 0.6572. First quarter next year 0.62, 60, 58, and 58 throughout next year. First quarter 2017, gradually stabilizing on the dollar, 0.60, 68, 70, 72, respectively. Second, third, fourth quarter 2017. Let's have a look at the last three here. Now the USD Canadian dollar, the loonie here is also expected to rise gradually versus the US dollar throughout 2017. However, next year we're expecting first quarter 135, 137, 139 for the Canadian dollar, and 141 at fourth quarter 2016. Let's have a look at first quarter 2017. We're looking at 0.41, 35, 30, 25 respectively, about the loonie. The euro versus the Swedish Kronor and the Norwegian Kronor are the final two, as well as those exotics are extremely volatile. As we know, Norway is one of the major exporters in crude oil, in Brent crude in the Eurozone. So it is highly sensitive to change in oil prices. That's why we see such a huge plunge in the Norwegian Kronor. Well, not only I've spent 7 years there, but what is good to know about those two countries is the volatility that they can bring on a daily basis. We can see 200 to 300 pips in change of price in or range for 1 day. So it is possible, and I've seen that, and I've been trading this, especially against Norwegian Kronor, to see change with 100, 150 pips in about a couple of minutes time. Let me just, sorry ladies and gentlemen, I gotta place a few positions here. So the prices are starting to move, so I cannot really wait. I was planning to be 10 minutes ago done with the webinar, but how to say, it's a lot to talk about, so thank you very much for bearing. Okay, Swedish Kronor, Euro versus Swedish Kronor, 9.2727 when I took the price. We have 9.50 first quarter 2016, mostly unchanged throughout the whole year, and will slightly, gradually start to decline versus the euro, when, of course, the Eurozone is expected to start tightening policy in 2017. Norwegian Kronor is the same case, almost unchanged throughout the whole next year. However, it is expected to decline because of the oil prices slightly. So price I took, 9.1929. First quarter slightly higher, 9.25, 9.25. Third and fourth quarter around 9, and it's going to fall below 8 kroners per euro throughout the first to fourth quarter 2017, and of course it is expected to go even below that. Actually, 7 kroners per euro. I haven't seen this particular exchange rate since 2007. So imagine that. Well, ladies and gentlemen, that's all for today. Thank you very much for joining me for this particularly important session, as well as the one from on Wednesday. So now we will focus on the US data that's coming out. It is expected to be better, so we're expecting the dollar to rally, gold to decline with at least another $10 today. Also, we're expecting a few hundred pips of slide in euro prices, and that is all in the hands of the retail sales. So I wish you successful trading. I'll see you next week. We will talk a little bit about technical strategies for the first quarter of 2016, which exactly will be more suitable. Thank you very much for joining us. See you next time. Bye-bye.